IFRS 8, or International Financial Reporting Standard 8, is a key standard for clear disclosure in financial statements. It replaced IAS 14 and helps users evaluate business activities and economic environments. IFRS 8 is crucial for investors, providing insight into company performance and enhancing comparability. The standard applies to publicly traded entities and those issuing public securities. This ensures vital disaggregated information is available, promoting fairness and transparency in markets. Segments are identified from an internal view based on management's regular review. This aligns internal and external reporting, showing how the company is actually run. Ultimately, IFRS 8 supports efficient and fair capital markets. What is an operating segment? It's a distinct part of a company that earns revenue and incurs expenses. Its results are regularly reviewed by the Chief Operating Decision Maker, or CODM. This review is fundamental for segment identification. Not every unit qualifies. Support functions like corporate headquarters don't count. The focus is on business lines or geographic areas that generate or expect to generate revenue. The CODM, which could be the CEO, COO, or a group, allocates resources and assesses performance. It's a function, not just a title. Regular review by the CODM is key. Discrete financial information must be available for each segment. This means separate financial results exist for that part of the business. The CODM uses this information for resource allocation. Without discrete data, it's not an operating segment. This requirement ensures segment data is reliable. Only segments with clear separate financials are reported. This keeps segment reporting meaningful and consistent. IFRS 8's management approach requires companies to report segment information as used internally by management. This ensures relevance, reflecting how leaders actually monitor the business. The process starts by identifying the CODM and the business components they review. These components become potential operating segments. The internal reporting structure guides external segment disclosure. Sometimes segments can be aggregated if they share similar economic characteristics, products, processes, customers, and regulatory environments. Quantitative thresholds apply. A segment is reportable if it meets 10% of combined revenue, profit or loss, or assets. Reportable segments must cover at least 75% of total revenue. If not, more segments are identified. This approach ensures users see the business as management does. It makes segment reporting practical and relevant. Aggregation and thresholds keep disclosures focused. The result is a clear management-driven view of company operations. What must companies disclose under IFRS 8? For each reportable segment, they must provide general information, how segments are identified and what products or services they offer. Segment profit or loss and total assets are required for each segment. Liabilities are disclosed if regularly reviewed by the CODM. These are key performance indicators for each business part. Measurement principles matter. Amounts disclosed should match those used internally by management. This aligns with the management approach. Reconciliations to company totals are required for segment revenues, profit or loss, assets, and liabilities if shown. Entity-wide disclosures are also necessary, even if there's only one segment. This includes information about products, services, geographic areas, and major customers. These disclosures provide essential context for users. They ensure transparency, even in simpler company structures. The goal is to give users a full picture of company operations. Consistency in measurement and disclosure is key. IFRS 8's requirements make segment data useful and comparable. This supports better analysis and decision-making. Let's look at examples of segment reporting. A large technology company might identify segments by product lines: personal computing, cloud services, and gaming. For cloud services, the company discloses revenue, profit, and assets, plus a brief description. This helps investors spot growth areas and see resource allocation. A global retail chain might segment by geography: North America, Europe, and Asia. For Asia, the company reports revenue, profit, and assets in that region. Segment reporting highlights how different parts of a business contribute to results. These examples show the practical value of segment disclosures. Segment information is invaluable for investors and stakeholders. It reveals growth drivers and underperforming areas, leading to better investment decisions. Stakeholders can allocate capital more wisely and assess risks more accurately. Different segments have different risk and growth profiles. For example, an emerging market segment may offer high returns but also higher risk. Segment reporting makes these distinctions clear. It builds a more accurate risk profile for the company. Analyzing historical segment data improves forecasting. Users can predict future performance by segment, then aggregate these forecasts for a more reliable outlook. Segment reporting also increases management accountability. When results are broken down, it's easier to see where management succeeds or fails. This transparency drives better decisions and strategy. It encourages responsible management of each business part. Segment information supports trust and confidence in financial reporting. It's a powerful tool for all users, investors, creditors, and analysts. Ultimately, it leads to more efficient capital allocation. That's why segment reporting matters. In conclusion, IFRS 8 is vital for modern financial reporting. It requires companies to disclose detailed information about operating segments using the management approach. This lets users see the business as management does. We've covered how segments are defined, identified, and reported. Key disclosures include segment revenues, profits, assets, and reconciliations to company totals. Quantitative thresholds and aggregation rules keep reporting focused and relevant. The benefits of transparency are clear. Segment information allows users to look beyond consolidated figures and understand performance, risks, and prospects. This deeper insight is essential for investors and other stakeholders. Transparency builds trust and supports better decisions. Understanding segments is crucial for anyone using financial reports. IFRS 8 provides a clearer, more detailed view of company operations. This contributes to efficiency and fairness in global capital markets. Segment reporting is not just a requirement, it's a tool for better business understanding. Embracing it means embracing transparency and smarter decision-making.